Well, Happy New Year. Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Before we dive into today's webcast, I do want to address the breaking news that Prime Minister Justin Trudeau has announced his resignation. Mr. Trudeau declared his intention to stay on as Prime Minister until a new leader is chosen and has asked for the prorogation of Parliament. That's until March 24th of this year. So we're going to be sharing insights on this development throughout the week, including an expert analysis of what's next. Part of that is being taped later today. And then tomorrow, a former Liberal advisor will be joining portfolio manager David Way in the discussion here on Fidelity Connects. So stay with us this week and keep an eye on your inbox for any updates. Back to the global markets for now. We saw a higher open to Wall Street and to Bay Street, and investors are going to be watching, of course, on Friday. We'll see the December jobs data coming out. We'll be watching for signs of the U.S. economy's strength. And as we step into a new trading year, what were the key takeaways from last year? To what extent will they continue? And how can we ultimately apply what we saw and lessons from those to navigate the markets in 2025? Well, joining me now to unpack the macro themes on his radar and to set you up for the trading week and the year ahead is Fidelity Director of Global Macro, Jurrien Timmer. Happy New Year. Great to see you. How did you spend New Year's?
Good morning and Happy New Year to you and to everyone watching. I had the privilege of actually getting an invite to the big Bitcoin 100K New Year's Eve party in Miami Beach at Michael Saylor's house, no less. And so that was an invitation I could not pass up. So me and my partner went and had a soiree with a few hundred of our closest Bitcoin friends, including some real OGs, and it was a very nice party. Not as excessive as maybe I would have expected, so that's good, because if it was like an over-the-top Predators Ball party, I would have said, okay, that has to mean that the peak is in for Bitcoin. So fortunately, I didn't have to make that proclamation, but it was very nice. So I spent the night in Miami Beach.
Fantastic. That's great. That sounds fantastic. How interesting. Well, let's get down to what you have taken us through. You'll take us through a little bit this discussion of what continues from last year, because of course, it's a matter of days. I mean, it is a new year and we have all kinds of new fitness goals and so on. But at the end of the day, we are continuing a whole lot of what we did last year and saw and traded on last year.
Yes. So maybe we started slide 7. So yeah. So and the way I kind of wrote this week's report, which will be on LinkedIn and X in the coming days. Us technical analysts, we tend to think in terms of chart patterns, right? So when the market is trending, obviously price discovery is happening, new information is being absorbed, and that often will move the markets. And then there are other times when the market's sort of congesting, and we call those, continuation patterns. And so the question is, will the trend, continue? And as you can see here, the bull market, the cyclical bull market, is now 27 months old. The price gain is 70%, and the market obviously is in a bull market where the S&P is up handsomely today. But the breadth underlying that trend is what we've talked about so many times, and we noticed that at the end of the year last year, there was a notable deterioration in the number of stocks participating. So if we go to slide 6, here's one of my favorite indices, the equal weighted S&P still remains in an uptrend, so there's nothing wrong with the market there. But if you notice, we spent last year most of the time with about 75–80% of stocks in uptrend, so above their 200-day moving average. And that dropped off quite significantly in the last few weeks of the year. And so we're starting 2025 with only 57% of the stocks moving higher. And so that brings us back to the familiar story of the Magnificent Seven. And will 25 look more like 24 or maybe more like 23, right? In 2023, the market went up over 20%. And by the way, we've now done 2 back-to-back 20% plus rallies. And the last time we did that was from 1995 to 2000. So obviously a fitting parallel, given that we had the internet, dot-com revolution back then, and we have the AI revolution today. But in 23, if you were not in the right stocks, those Mag 7, it really didn't feel like a bull market at all because not that many stocks did well. And so a question is, will 25 be more like that, or will it be more like 24, where there is broader participation? And my guess is it will be more like 24 in terms of the overall economic fundamentals, earnings, but there could be some headwinds as well in terms of higher rates, higher yields, I should say, a bear steepener, maybe fewer or no more rate cuts from the Fed. And in that sense, maybe we're going to look more like 2018, which was, of course, the second year of the first Trump term, where earnings were very robust after the tax cuts, but there was a lot of pressure from interest rates.
That's so fascinating. And I want to go back to the interest rate story, and I'm sure it will dominate what part of what we're talking about today. But just as this breaking news has come in, and it just fits with the overall political story globally that things are changing. There's a lot in the equity market to point to Mr. Trump winning in the United States, the him incoming. I mean, there's a lot of discussions about to what extent things have been priced for that already from the equity side. But I'll bring in this question right now up at the top. Jurrien, political leadership change in Canada obviously is afoot. Leadership change is happening in the United States. We know generally what happens to markets in times of change. Well, we've witnessed some of it.
Yeah. No, it's certainly interesting, certainly to note the political developments in Canada. But you can see that, the election in the US, is a little bit of an earthquake in terms of the repercussions, the ripple effects around the world. And you see this with, Elon Musk, being very actively tweeting on various political fronts. Even like commenting on the UK and Germany, the AFD, which is the right-wing party. And you see, Trump inviting, people, the officials from Italy over to Mar-a-Lago. So clearly, there's a new world order, and it's moving away from sort of the globalism movement and towards more of I don't want to call it an isolationist movement, but it's clearly a new world order, and dominoes are falling in various places, not just in the US. And I think, the news in Canada is maybe a little bit a part of that narrative.
Yeah, it's fascinating. So, I mean, markets themselves, we saw what they did after the November elections in the United States. There's a massive rally across, not quite across the boards, but certainly huge. I wonder if we could just dig in there for a minute on the continuation that's linked to the political story there and a new world order, as you're talking about. I mean, what is priced in? Because some things got pretty lofty towards the end.
Yes. So if we go to slide 10, so ultimately, markets come down to earnings, interest rates, valuation, sentiment. And, again, if we go back to the first term of President Trump, 2017, 2018, of course, taxes were cut back then. We had a big earnings boom. And in 2017, in many ways, it kind of had parallels to 2024, where you had broad participation from earnings, amplified by an increase in valuation. So that was sort of the Trump trade in 2017. And then in 2018 sort of came a little bit of the hangover because the economy was hot enough that Jay Powell back then, who was just at the Fed at that point, wanted to normalize rates, continuing the work that Janet Yellen had started in 2016. And then in 2018, in the summer, he really pushed rates back above 3%, which at that point was, pretty wild, given that they were at zero. And the bond market sort of had a tantrum. And then, of course, we had that big correction in the fourth quarter of 2018. And I'm not calling for a repeat of that, but the markets had a tantrum. They fell 20%, and that caused the Powell pivot in early 2019. And I'm just saying that to highlight that, after the party sometimes comes the hangover. And I think for me, so the earnings side, I think looks good. Here you see in this chart, the various calendar year estimates for the S&P 500, and you can see that 2024 number, that gray line, has been very, very steady, which is a good sign. And sequentially, each new year is showing a pretty big uptick. And so the earnings story seems to be fine. But what I would say is my main worry, and maybe we go to slide 18 there, is that we obviously had this big inflation problem in 2022 from the COVID lockdowns, supply chains, an incredibly large fiscal stimulus that I think the Fed, in retrospect, probably underestimated in terms of how potent that was. So the Fed probably, I wouldn't say it eased too much, but it eased for too long. It stayed easy for too long. And then it had to try to put the inflation genie back in the bottle, which it mostly seems to have done. But inflation in 2024 has kind of been sticky at the 2.8, 3% level, which of course is higher than the Fed's target. And my concern is that if the economy gets its animal spirits back, which certainly seems to be the case, and that's part of the Trump trade, that's part of the earnings story, less regulation, extended tax cuts, et cetera, et cetera. The worry is that if that inflation genie was not completely put back in the bottle and the economy now reaccelerates, that actually we could be kind of in a new normal of higher than targeted inflation, that 3 is the new 2, or even 3.5, or maybe even 4. And if you look at this chart, this shows various iterations of the Taylor rule, which is an algorithm that kind of tries to set a rule about where the Fed funds rate should be based on inflation, where it is relative to the Fed's target, and where the unemployment is relative to kind of sort of the natural rate of unemployment. And you can see that those lines have come down. So that is the green light for the Fed to ease, which of course it did. It eased by 100 basis points in 24. It eased 3 times, which is exactly what the Fed said it was going to do a year earlier in its SEP from when that pivot party started a year ago.
The market was having none of that a year ago, though. They doubled it.
Exactly. The market was expecting 7 rate cuts, but the Fed was right. It did 3. But you see those squiggly lines are now sort of flat. They flattened out. And the reason they flatten out is because the unemployment rate is now much closer to the natural rate of unemployment as the labor market rebalanced, and because inflation is no longer making further progress towards that 2% target. So the conclusion that I have from this chart is that the Fed did the right thing. It's at the right place. 4.25 to 4.5 is the appropriate level, I think. But the Taylor rule is suggesting that until inflation softens further, the Fed is sort of done here for now. And I think the Fed is already making waves, like it's already making comments to the effect that maybe they're going to wait to see how much inflation further improves. And so that's a long way of saying that I think the prospect of rate cuts maybe have to be put on hold for now. And even though the Fed cut rates by 100 basis points last year, long rates jumped by 100 basis points, so which is what we call a bear steepener, slide 16. And so the curve is bear steepening, meaning long rates are going up. And that brings me to a conversation we've had many times about the Fed model. And, equities have to compete with bonds, which is the risk-free asset. At least, some people might argue it's no longer risk-free, but let's just assume for a moment that bonds are still the risk-free asset. Bonds are yielding close to 5. Equities are yielding around 5. And so if bond yields go up, the stock market has to compete with that risk-free rate. And it has to do so at a time when the PE levels are in the low 20s, and the cyclically adjusted PE ratio, the CAPE ratio, is in the high 20s, if not in the low 30s. So if yields kind of have move higher at a time when the stock market is pretty expensive, I could see how that would sort of disrupt or interrupt the bullish momentum that we've seen. And when you add all of that to the sentiment picture, which is slide 13, you can see that this is all happening at a time when people are really enthusiastic about the stock market. This chart shows the flows into last year, into the end of last year, and that's the Trump trade in action as well. So you add all this together, right? You have bonds being, a very viable asset again at 4.5%, 5%. The days of negative real rates are sort of behind us for now. And so bonds and cash actually are competitive. And the stock market, of course, historically is the place to be because you have these compounded returns of 10+%, and the 10-year CAGR for the S&P right now is at 13%. So certainly the best asset around there, other than maybe Bitcoin, but that's another conversation. But at the valuation levels that we're seeing and the sentiment levels that we're seeing, it may be that the earnings momentum that is clearly underway is not going to be enough to keep the market from occasionally reacting to these sort of rate tantrums that we've seen since 2022 on a number of occasions, and which I suspect we'll see again in 2025.
Fascinating. One thing that is carrying on is sort of the discussion about Fed independence. There have been vocal discussions, President-elect Trump not wanting rates to go higher and for them to come lower. It seems like everything you just pointed out there, there's a question in there about where the Fed's independence lies at this moment. Maybe you can remind us.
Yeah, so the Fed, has been independent since 1951. That was the Treasury Fed Accord. Before that time, the Treasury was really just an arm of the Treasury, right? So the way the thinking always was back then that Congress sets spending, and if Congress it decides to spend more than it takes in, that's Congress's decision, obviously with the president. Then it's the Treasury's job to fund that deficit. And it's the Fed's job to help the Treasury fund that deficit, right? So during wartime, the Fed would do quantitative easing and did so during World War II, but it did it before then as well. So that was kind of the Fed's job, is to help fund wartime deficits. And then in 51, the Fed became independent, and even though it has been independent officially ever since, there are times when the Fed sort of, plays along on the fiscal side, like it did in the 1960s, for instance. And then there are times when the Fed really leans against it. And obviously, the last couple of years has been a time when the Fed has leaned into the fiscal potency of what we've seen in Washington, 6-7% deficits year after year. Obviously, that happened during COVID, and the Fed had to ease then, of course, for obvious reasons. But since then, the Fed has really leaned to the other side, and that is in part why the dollar is actually so strong. And so the question is, now that we have a new order in Washington, will the Fed remain independent? And I think as long as Powell is in charge, it certainly will. But when he retires in about a year or so from now, you wonder who gets put in charge, because that is someone who gets nominated. It has to be approved by Congress, but someone who gets nominated by the president. And then if the Congress is relatively friendly to the president, you could see maybe someone more dovish being in. So I don't think it will be a question of Congress taking away the Fed's independence through a legislative act. I don't think that's in the cards at all, but you could see someone being in there that is a little bit more open-minded to whatever way that the winds are blowing. And certainly when you have prolonged and persistent deficits, as we are likely to have in the US and in many other countries, including Canada, the UK, Europe, China, Japan, at some point you wonder whether central banks become a little bit more complicit in helping fund those deficits, as they have been, for instance, in Japan until recently.
Right, really interesting. One thing
but I don't think it will be like an over thing. It won't be like some legislative act. It'll be kind of behind the scenes.
If we go back again at some of the other rate sensitive stories that fit into this piece of 2024, I mean, gold obviously sort of continues to sniff out whether there is going to be inflation, or at least the uncertainty around that. And then the sectors themselves that carried the day last year and those that were the laggards. I wonder if we can sort of dip
Yeah.
into those a little bit and bring back that continuation story.
Yeah, let me start with gold, slide one. So to me, gold gets the MVP award for 2024. So as you can see, Bitcoin stole the show yet again, up 120%. But look at gold, gold up 30, and the S&P up 25. So gold went up more than the S&P, and that on by itself may not be earth-shattering. But if we go to slide five, which is my very busy chart showing correlations, and I don't expect the viewers to be able to read that, but if you look at the red squares are asset classes that are positively correlated to the S&P, and obviously the redder it becomes, the more correlated is, and the blue ones, which there are not many of them, are negatively correlated. And the most negatively correlated asset to the S&P is gold. And this is for the last 12 months. So you have an asset that outperformed gold, the S&P, by going up more than the S&P did, even though it is the most negatively correlated asset against the S&P. And to me, that is a hat trick that is pretty impressive. So gold gets MVP, but of course, Bitcoin steals the show. And actually, if we show slide four, you can see all the various asset classes that I track. And this is just for the calendar year 2024. And you can see, obviously, Bitcoin way up there, the Mag 7 right behind it. And if we look at the sectors, which is slide nine, this is for the S&P 500, you can see a pretty wide dispersion, right? So obviously tech telecom on top, followed by consumer discretionary and financials. Financials had a huge run after the election because of the regulatory implications, and also the yield curve has uninverted, so that's generally good for banks. And then at the bottom, you have energy, real estate, which of course is a bond proxy, and materials. And to me, kind of the standout in this chart, because most of that sort of is intuitive, but the standout is that utilities did actually quite well. Not quite as well as the S&P, but utilities generally only do well when the world is ending, because it's a very low beta sector that has very stable, kind of boring earnings. But this shows the AI phenomenon at work, because there's a component of the utility sector. So part of it is the highly regulated electric utilities that act like bonds. But now you have this part that is really an AI infrastructure play, data centers, power, that sort of thing. And so that shows you that the AI theme is really kind of, reaching out into sectors that otherwise would behave quite differently.
Yeah, that is absolutely fascinating to sort of see that. And in terms of the secular, you kind of put that into stark relief for us at the beginning. I'm kind of curious about the valuation story and just coming back to sort of what's been priced in, or what could get thrown off here in terms of valuations. I mean, the pricing was just astonishing last year.
Yeah, so if we go to slide 15, so this is the CAPE model, which we've talked about quite a bit. It's a slightly different variation of what we know as the CAPE model. So the CAPE model basically says that the cyclically adjusted PE using 10 years of earnings is a very good predictive indicator for the next 10 years return. And basically the premise is very simple, and that is that valuations tend to mean revert. So if you have a 10-year extreme, so in other words, the PE has very little, if any, predictive power over next year's returns, or even the year after that. But over the next 10 years, it has a very strong predictive power. And that's because on a 10-year basis, the PE tends to mean revert. So if PEs are very high today, which they are, it suggests kind of, a lost decade, over the next 10 years. And so my variation of the CAPE model is I use the 5-year PE, and I use not the earnings, but the total cash. So dividends and buybacks. And the reason I use that is because buybacks are a very powerful tool, or are a very powerful thing, because it returns shareholder capital very quickly to those shareholders. So higher buyouts, higher buybacks should result in higher PEs. So the 5-year price to cash, very, very close predictive correlation, inverse correlation to future returns. The return for 2024, the 10-year return that the model uh, predicted 10 years ago was 14%, and the actual 10-year return as of December is 13%. So the model is very, very accurate. And as you can see, it suggests that the next 10 years are not going to be as good as the last 10 years. And that echoes other reports we've seen, one from Goldman Sachs a month ago or so. But again, we're looking at 10-year annualized return. So it tells you nothing about what's going to happen over the next year or even the next 2 years, but it does suggest that over the next 10 years, the returns will be more below trend than above trend. And my model suggests that for the next couple of years, things will stay pretty good. And that's why kind of this 7 and 7 market that we've talked about, seventh inning of the cyclical bull and seventh inning of the secular bull. And that remains my theme going into this year.
Fascinating. I mean, does it make a case ultimately for taking a look beyond the US exceptionalism question? I mean, much of what's being sketched out here fits in with that story, but maybe on a longer term basis, when does that shift, or could that
Yeah.
shift?
That of course is the question, right? So if we look at slide 12, you see NVIDIA as sort of the poster child of today's boom. And when you look at the slope of that chart, and you compare it to Cisco in 1999, which was, of course, the poster child of the dot-com boom, and you look at RCA, the radio company back in 1929, they all look exactly the same, and it gives you pause, right? Because these markets have really skyrocketed, and it certainly seems unsustainable, at least at first glance. But until there's a catalyst, it's hard to see this train stopping. And even like I put Bitcoin in there as well, and that had the same slope, but now it's at 102,000. So these things are not necessarily that predictive. But what is predictive, I think, will be the fundamentals, the earnings story. And I'm looking for my slide here, slide 11. What happened during the dot-com bubble was that these stories were overbelieved, that the trades were very crowded. Analysts had to kind of change the definition of earnings, eyeballs, engagement, all those things to kind of justify the price. We don't really have that today. The earnings are very solid. So here's the Mag 7 relative to the other 493 stocks. That's the gray line. So the Mag 7 has outperformed by a 12x over the last 10 years, which is remarkable. But you look at the earnings squiggles for the Mag 7 at the top versus the rest of the market, and the rest of the market looks fine from an earnings perspective, but the Mag 7 are just growing by leaps and bounds. So to me, for that trade to unwind and for the market to truly broaden, not only within the value and small cap spectrum, but outside the US as well, something needs to kind of start eroding on that earnings side. And, the PEs are up there for the Mag 7, 38 times earnings. The rest of the market's at 22. So that part is expensive. But again, as long as those earnings estimates are growing, it can continue. So maybe again, in that sense, 25 might end up looking more like 23 than 24.
Interesting. I mean, could a catalyst be tariffs not being as bad as we think?
Yeah, and that was a headline this morning that President-elect Trump has already dismissed, but that was the reason why the market was already up this morning, and even though the headlines have been dismissed, the market's still up. But it's that sector is eating everything else, right? I mean, those 7 stocks are already 30% of the market, and certainly if there is less bad news or less disruption in the economic scene from Trump, then that could certainly play a role. And one other element, and I know we're running out of time, is that the new the re-elected Speaker of the House has said that they only really have they're going to try to do everything in one bill in terms of the Reconciliation Act, with the debt ceiling, and that suggests that there won't be a lot of funding available immediately for immigration, for like deportations. And so that would, and think what you will about, immigration and all that stuff, but from a market perspective, that is also a benign outcome, right? Because if you start deporting millions of people, that's going to upset the labor market and would presumably boost inflation. So those are the two things that I think are kind of helping things. And so in that sense, the less Trump does that is disruptive, the more this whole momentum can continue in the market.
This is fascinating. Fascinating to begin the year and taking a look at last year. Jurrien Timmer, thanks for driving us into the new year with all of your insights.
Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.